What the fuck even is a mortgage?
I fucking love it. How about that? It's a male-dominated industry. Women are starting to take over, though.
If I were to come to you as a first-time buyer, what would be the questions that you would run through?
I wish more people started that way.
Should I be buying or renting? Is refinancing the same as remortgaging?
Those four walls close in really fast if you can't have a life outside of it.
What is a 5 to 7 year loan versus the 30-year mortgage?
It was the movie to a T.
You could get penalized for paying off your mortgage earlier.
Yes.
Why would that ever be the case?
Yes.
I never understood what that meant.
Huge red flag run.
So much more makes sense.
So many women think that they can't do it on their own, and they absolutely can.
Okay, we're ready. I got a lifetime of knowledge.
Let me call Mimi.
Welcome to Actual Experts. I'm Caitlin.
And I'm Lundy.
And we don't have all the answers, so we are going to ask the questions.
And today we are asking, what the fuck is a mortgage? To actual expert Kristin Ambos, who is CPO at Point Mortgage Corporation. Truly, what the fuck is a mortgage?
Who is to say? No one knows. It's so funny. One of our friends who wrote in early on requested this episode, and she wrote, please do what the fuck is a mortgage, because I have one and I still don't know what it is or how it works. And I'm like, yeah, correct.
Yeah, I think this was like one of the truly the inspiring topics of the podcast. We were like, what is investing?
Yeah.
What even is egg freezing? And truly, what the fuck is a mortgage?
Yeah, personal finance. It's just like all these things that we are told we need to know. And then we get to that point in life and we're like, well, no one told me. No one told me how to do this, how it works.
Right, exactly. And I think I was chatting to Chloe about it last night, and she was like, well, a mortgage is just like it's a loan, right? That you take out from the bank to buy a house. And I was like, maybe it could be. Is it? I don't know. But my question that I've never known the answer to, and I feel like I've asked my dad this at some point, and he's probably very patiently tried to explain it to me, and I still don't understand it. So that is why we're here today, is like, if you buy a house for $10 million and you have a
this podcast is going far. Lundy's buying a $10 million house, everyone.
I use 10 as an easy figure. However, that would be nice. For $10 million for like a 30-year mortgage, and you're paying it off. But then something happens and you lose all your money and you have to sell that house to buy a much cheaper house, like a $2 million house.
Awesome.
Life is still good.
Yeah.
What happens to your mortgage? If you sell your house 5 years into your 30-year mortgage, what happens to the original mortgage?
Okay, I'm going to say what I think happens, and this is purely speculation. Never once have I read any article or anyone told me anything, but this is what I think it is. And then we can see if Kristin proves me right or wrong. Okay. I think that you're basically like co-buying the house together. And if you borrow like 75% of the cost of the house, the bank technically owns 75% of the house. And over time, you're essentially like buying it back from the bank with a premium, with interest for having lent you that money. And then if that happens in advance, I think you have to then give the bank whatever percentage they still own. So if you've been paying it for 4 years and you've only paid off whatever 10%, then you still have to give them 65% of the value of what you sell it for. That's my guess.
Wait, first of all, how did you go from 10% to 65? I thought you were going to say...
Well, no, because if they gave you 75% of the value and you've only paid off 10%, and so then they still own 65. Yes.
That your logic makes sense. However,
yes,
I lost all my money. I'm broke now. That's why I have to sell the house. Why I can't pay the bank back 65%. I just told you I'm broke.
Well, when you sell the house, you'll get money. And then that money goes straight to them.
What if the house doesn't sell? What if the house doesn't sell?
Then I think they do foreclosure. That's when foreclosure comes in. And then the bank takes the house and then they sell it at a discounted rate, and they're willing to get any money back.
But then how am I supposed to buy another house? I'm just like homeless?
You don't. You're homeless. Lundy spent too much money on her $10 million house and did a budget with Cameron properly, and now she's homeless.
It's like... Yeah. So honestly, we've got questions. Let me tell you. We've got questions. But let me give us some key facts and figures.
Yes.
and then we'll get into it. So, okay, interestingly, the median home price in the US, according to the National Associations of Realtors in 2025, is approximately $420,000. For California and New York, the median is around $900,000. So it goes to show,
Makes more
like,
sense.
there's a big spread.
Yeah.
Obviously, like across the United States, but interesting to kind of, understand what an average house costs.
Yeah.
Nearly 60% of home buyers purchase with a partner or a spouse,
Yeah.
but in 2024, 19% of buyers were single women,
Ooh. Well done,
which we
ladies.
love.
Yes.
Single women made up, I just said 19 or 20% of all home buyers in 2024, while single men made up about 8%. So
That's very
more single women
interesting.
are buying homes than single men. However, despite this progress, single women often enter the home market with lower incomes than single men.
Hmm.
So while single women are buying homes at increasing rates, their homes tend to have lower values than those bought by
Interesting.
men or couples.
That's so interesting. I feel like there's two follow-on questions I have there that no one other than an expert would be able to answer these questions that I have. Number one, I want the anthropological study on that. Like, why are more women choosing, even with lower incomes, to enter the market? Is it like lower risk, they think, and therefore more stable for place to put their money? Maybe we like to nest and we're just like, do you know what? I just want a cute apartment and I want to make it my own. And
Yeah.
I want the anthropological study on that. And
Yeah.
then on the other side of it, the finance side and the guys earning more money, I wonder if they think they're going to earn more money in the stock market and they're not putting it into homes.
Yeah.
I guess
Only
that's kind
8
of the same.
single men. It's interesting. I
Yeah.
know. So curious. Also, interestingly, more millennials and Gen Z buyers are turning to co-buying fractional ownership or rent to own models due to affordability constraints. So, to the surprise of nobody, it
Yeah.
is much harder for our generation to buy homes straight out.
Yes.
So,
Interesting. Is that like a
unclear.
timeshare?
Yeah,
Where do
unclear
you
what.
live when you can't live in your home?
Yeah, what is a fractional home ownership?
And
Fractional home ownership is a co-ownership arrangement where multiple individuals purchase a property together, each
mhm.
owning a percentage of the property and sharing its cost and usage rights. So it is kind of like a timeshare, but then I guess do you all have to live together?
I don't know, but that sounds like a recipe for disaster to me. What if you have
Yeah.
different interior design tastes like that? I truly, you're like, but I own this.
Specifically,
Yeah.
the interior is what I'm concerned about.
Yes.
Also, interestingly, a recent study found that 38% of home buyers under the age of 30 received
Hmm.
family money for down payments. So
Yes.
that's over a quarter of home buyers under age 30. Who the fuck is buying a house under the age of 30? Apparently 38% of, oh no,
Yeah.
that's incorrect.
But
But
still,
38% of those homeowners under the age of 30 receive family money for down payments. Duh, because
yeah.
how
Who
else is
can
anyone
afford
supposed to do
it?
it? Yeah,
That's wild,
I
but
know.
well, it makes sense. The crazy part to me is not that they're getting support, it's that they're buying a house under the age of 30.
Yeah, literally.
Yeah.
Who are you? Show
Yes.
yourselves.
Exactly.
Um, and finally, according to The Guardian, the number of first time home buyers in the US dropped to a historic low in 2024, approximately 1.1 million first
Wow.
time home buyers. And the average age of first time buyers is now around 38 years old.
Uh,
So
that is crazy.
we are not behind. Takeaway
No.
number one, we are
Yeah.
not behind. And it is so much harder for us to buy houses than our parents who bought homes for like $40,000 and then like
No.
10x their
Well,
even more.
I said this to Lundy, like my dad and mom were telling me they bought their first home for $235,000 in downtown Toronto, which now that house would be like $1.5 million. And my
Right.
dad's salary was $60,000 at the time. I'm like, well, that's most people's salaries right now. Like in
Yeah,
the
right,
housing
right.
market has gone up.
Yeah.
That like quadruple, tenfold, all these things, and cost of living has gone up, but the salaries have stayed the same. It's
Exactly.
crazy.
Exactly.
And I was like, congratulations. That's nice.
Yeah,
for
it
you.
has not been adjusted for
No.
inflation or cost of living whatsoever.
Womp
So, wah, wah, wah. So, I'm really excited to learn from Kristen what options you have at this stage of life and whether buying is actually better than renting. I feel like that's also just something that's been like ingrained culturally, certainly in America. The American dream is
Totally.
to buy your first house, and I feel like that maybe it has just like, come and gone. Maybe
Yeah.
it's like,
It's such an emotional thing too. Like Steven and I have
yeah,
been moving around so much, and we're like, oh my God, we can't wait to have a stable place right now and have a home. And we were like, do
yeah,
we buy? Because we just want to like not move for the next 5 years or 3 years
yeah,
or whatever it is. That is my biggest question going in is how do you know when to buy versus rent? And is
yeah,
renting more economical? Like,
yeah,
are you just not going to get your returns that you're looking for on your home if
yeah.
that's part of
I think there is
your,
a way. I'm curious if she said like there is a way to do a calculation with the
yeah,
formula that says like what your mortgage would be. Plus, it's also not just the sticker price of the house. And then you become, if anyone's ever dealt with their landlord about any like nook and cranny problem in your
totally.
flat, like you inherit all those things. So it's not just
Leaks, all of it. Yeah.
totally, yeah. And there's like property taxes and like there's so
Yes,
much. It's like not just buying a house. It's like
I
all these
know.
different things.
It's very expensive. There
Um,
is a thing called house poor, which I was chatting to my cousins about because they were talking about buying a house and they love their lifestyle right now. They're paying a relatively low rent on their apartment. And they were like, we don't want to be house poor. We don't want all our money to go into the house and we don't have
yeah,
any money to live. And we have friends in the city that we were chatting to who were like, we have great incomes and a great household income, but our mortgage is so high, we can't live our lives. And they're like, we
yeah,
regret getting such a high mortgage, which I'm like,
totally,
yeah,
totally,
lots to think about.
totally. Totally. So let me introduce you to our actual expert who will
Yes.
be answering all these questions for us today. Kristen Ambos is Chief Production Officer at Point Mortgage Corporation, where she's helped hundreds of first time buyers, investors, and families navigate one of the biggest financial decisions of their lives, buying a home. With nearly 2 decades in the mortgage industry, Kristen is known for making complex lending terms and interest rate talk actually make sense, which is a true superpower.
Yes.
She's passionate about educating clients, especially women and first time buyers, on how to build long term wealth through smart home financing.
Yay.
And another little fun fact about Kristen, she has also been the #1 female loan officer in the state of Wisconsin for the last 3 years. So,
Wow.
another
That's
fun
amazing.
way, yeah, to celebrate women in
Yeah.
a very male dominated industry.
Yes. And she is also my mom's best friend, good friend. That's how we got connected. I messaged
Which we
my
love.
mom's friend who's a real estate agent and I said, Jane, hook a girl up. And she said, I know just the woman for you to speak to. And so
Love.
here we are. Yeah.
Love it. Yeah, we're so excited. She's so excited. She emailed me earlier today. She was like, I can't wait. So this is going to be a good one.
I'm clapping like
Let's,
this because Lizy told me to stop clapping on the podcast, but I can't not do the movement. So I'm like,
this one's for you, Lizzie.
yes.
Okay, let's
Okay.
bring her on.
Woo!
Please note that this pod is for educational purposes only. Nothing we say should be taken as financial, legal, or medical advice. Please do your own research, and when in doubt, ask an actual expert.
No, that's perfect. Have you ever done a podcast before? I know you have some content on your Instagram, but have you done podcasts?
Yeah, so I have my own podcast that
Amazing.
I do. I started it last year, and then in this industry, it's really hard to get people to commit to anything in the summer because it's so busy. And I think one of you is from Wisconsin, right?
No, my mom's best friend is Jane, who reached
Oh,
out to.
yeah.
So Jane is originally from Toronto, which is where I am now. And my mom and Jane went to university together and are still best friends. And Jane was at my wedding in April
Got
this
it.
year. Yeah,
That makes total sense. But being in Canada, you kind of understand too, like we're very seasonal here.
totally.
And
Makes sense. Well,
I'm not
I'm from
working.
California. So I'm also American. I grew up in LA.
Okay.
I'm here in Cape Town, South Africa, which is where Caitlin and I have spent a lot of time. Caitlin just moved back to Toronto from
That-
Cape Town. So we have a global audience, but
That's
we know that a lot
amazing.
your expertise will be probably US centric, if not North America centric, but we'll try to speak to, mortgages are everywhere. So
Yeah.
just to give you a little kind of introduction into how this works before we dive in, we tend to split up episodes between Caitlin and myself. One of us does the research for the episode, leads the interview. That'll be me. And then the other, which is Caitlin today, doesn't do any research at all, represents the listener. So she's going to ask all the clarifying questions of someone who's listening at home saying, what the fuck even is a mortgage?
Yeah,
effectively.
I love it. I fucking love it. How about that? I absolutely love the whole concept. I think it's fantastic.
Good. Okay, amazing. Yeah, so we do like to title our episodes What the Fuck Is. So today we are asking you, our actual expert, what the fuck is a mortgage? And I think that's probably the best way to kick us off. What the fuck is a mortgage? Is it just a loan with a fancy name?
Yeah.
Can you break it down for us?
Essentially, it is a loan, just like anything else with a fancy name. The mortgage is centralized to house, so to a resident. So that's really what the loan is. Instead of a car loan, it's a house loan. But what's different about a mortgage than like a car loan, for instance, is mortgages are recorded at the municipality. So it's public record because the deed on the house is transferred, so the deed has to be attached. If you buy it with cash, you still get the deed to the property. But if you don't buy it with cash and you leverage it via a loan, then that's where it's attached to, then that mortgage is attached to the property. And the reason why it's recorded is because we want to stay in first lien position. We don't want any other liens to come in and take position on that. And so if there was a lien or a judgment, let's say somebody had some medical mishap and they had medical judgments out there, those judgments would take a back seat to the mortgage because eventually judgments attach themselves to a property so that the creditor, if you will, gets paid.
Okay,
so
I have two questions there.
Yes, I know. That's just like a load of information.
So first one, I'll tell the first one is what is leverage and what is a first lien. So we can start. You started with leverage on that. You said leverage on the house, I think.
Leverage is basically using somebody else's money. In this particular case, you're using somebody else's money to buy what you need. So you're leveraging a bank and their money to buy it. So that's what a mortgage would be, or a loan. Whether you leverage a credit card to use money to buy something and then pay it back later, that leverage is always where are you using something else to get what you need. So you're leveraging their money to get what you need. If that makes sense.
Perfect. Yeah. Like leaning on the bank to help you buy something. Yep.
Absolutely. Okay. And then in return, we charge an interest rate to do that. So that's the give and the take. A lien is like a mortgage is a lien. So what it does is it puts, you've got your house, if you just picture a house. And on that house, a mortgage would then be put as what we call a lien. And it would be in first lien position, meaning that if that house was ever sold, the person of the lien would get paid first and foremost, even before the owner. So I own a home. I have a mortgage. My mortgage would be in first lien position, meaning that if I sold that house and made a profit, my mortgage company gets paid first, even before I do.
So from like the person you sold it to, the money goes directly from, so if you sell your house to Lundy, Lundy's money goes directly to the bank.
The lien first. Yep.
Got it.
It goes to the lien first. And if there's multiple liens, so some people have a second mortgage as well, where they use their equity. Instead of redoing their first mortgage, they have a second mortgage or a home equity loan. And so that would be a second lien. So the mortgage, the first lien would get paid first, and then the second lien would get paid, and then I would get paid as the owner out of Lundy's money.
Understood.
So, so if I have let's just say a $150,000 first mortgage and a $50,000 second mortgage, I owe $200,000. If I sell the house for $300,000, that $200,000 gets paid. I get $100,000 of Lundy's money. $200,000 goes to the banks.
What happens if, and I have so many questions around this, but this is a perfect
I
example to
love
kind
it.
of start visualizing it.
Sure.
What happens if you have a mortgage because you bought the house when it was more expensive? So it was a $500,000 house, and so I got a mortgage for that. But when I sell my house, it's worth less, and I don't make enough money off of the sale to pay back my first lien mortgage. What
Yes.
happens?
So then you need special permission, typically from the lender, from the mortgagee. So the mortgagee would be the bank. And you need special permission to what we call short sale that property. So you're selling it at a short. And
Right.
they need to okay it because they need to take that loss. Then
Ah,
my credit would be hit with what we'd call a short sale versus a foreclosure. So it would be foreclosure is when the bank takes it back because you've not held up your end of your mortgage that's recorded to pay it back. So if you don't do that, then the bank takes the property back in a foreclosure. So a foreclosure hits your credit pretty hard. A short sale will hit your credit in a negative way, but not quite as hard as a foreclosure will because the bank is still getting the majority of their money back. I've been doing this. I'm going into my 24th year of writing loans, and only 2 years of those 24 have we been in an area where homes are considered what we call underwater, or they're not worth as much as what people have borrowed. And that was during the housing crisis, or what we know now as the Big Short. They shorted the market via mortgages. A lot of investors to become wealthier, and they took advantage of a bad situation and played politics with it. And so I don't know if you've ever watched the movie The Big Short.
Yes.
yeah, it's a good
It
one.
is to a T. I've watched it multiple times, and I felt like I was living that life. Not so much me. I was only a couple of years into the industry. I got in the industry in 2002, but I would say it takes you a minimum of 10 years of being a loan officer before you're really, truly understanding all the markets, all the
Right.
rates, all the different nuances, because you have to go through 2 different political cycles. You know how we have elections every 4 years? Every 4 years, a different policy comes in, which changes, it doesn't always, but it can change housing. So that's why I say you almost need 10 years to go through 2 different political cycles to really understand all the nuances that come into our industry. So at that time, 2007, 2008 area, I was in for 5 or 6 years, but I was still very green. I was still learning. But I lived in that era where I can picture it now. We had a company with probably 30 loan officers at the time. And of those 30, 20 of them were these, and I'll just call it what it is, were these veteran men who had been in the industry, and they very well knew that they were ripping people off and they didn't care. And they were charging points. They'd walk through and be like, we just got 5 points in the front, then we made another 2 points in the back. And then to boot, if just following the Big Short, they would carry around cash bags in the office as they were going out to Vegas, to strip clubs and gambling. It was the movie to a T. And I sat back and I was just like, is this real life? I was too young and naive to really understand what was happening at the time, but my gut just was saying, this isn't right. I don't know what's wrong with it, but something about this isn't right. And it was infatuating to me because, of course, I'm seeing all this money fly. And I'm like, wow.
Yeah.
But at the same time, I was like, no. So then when it all came to fruition, I also watched many of those guys that I worked with lose their licenses, and rightfully. And I didn't feel bad for any of them, unfortunately, because they, in my opinion, had it coming. You don't rip people off. Karma always.
Yes, it's a reckoning.
It always comes back. All we had to do to get licensed prior to was pass a felony. Like you just did a felony background check and that was it. Here's your license. And now we have to go through continuing education and background checks. They pull my credit, I think every year or every other year to make sure I'm financially solvent to be giving information, to be giving people advice on this. And
it makes sense. It's similar to a wealth advisor who's giving you advice on your personal finances.
Absolutely. Absolutely. Those days were really real. And it's crazy now to think back looking at it. But I'm so grateful that so much of the Dodd-Frank laws came into play to protect our industry.
I have a few clarification questions. You said a loan officer. Yeah. What is a loan officer?
I love it. I love it. A loan officer is me. Okay. So I'm the loan officer, meaning I take in the loan from the client. I take the application. I take all the documents. I pre-approve them. I basically write the loan. So I'm writing the loan, and then my processor processes it, underwriter underwrites it, and then we get to what we call a cleared to close. Mm-hmm. And that means that my company has done their due diligence where they've double, triple checked my work to make sure I'm staying compliant, I'm not being fraudulent or anything like that. And then once the clear to close comes out, then we close on the loan, the client gets their money and buys the house. So the loan officer is the one who writes the loan.
Got it.
It is worth mentioning that you, Kristin, have been the #1 female loan officer in the state of Wisconsin for the last 3 years.
Woo-hoo!
Congratulations.
Thank you.
Incredible. It sounds like there's a lot of you, so that's incredible.
There are, and I was just so excited because coming up in this industry, it's a male-dominated industry. Women are starting to take over, though. They really are. And so I was chasing that #1 spot for many years. It was just more so I don't think I'm any better than any other woman loan officer, but for me, it was a way to show like, hey, I'm here. Because remember that story I told you when I first started? A lot of those guys I worked with, they just automatically would assume that I was only good at being a loan assistant, or I was only good enough to be their backup to help them do their job. None of them really were like, you got this, girl. And so as I came up, I did have a manager at my last company. He is a really big powerhouse in our industry still. And he looked at me and said, why not you? And I was like, yeah, why not me? Why not? And it resonated with me. And from that moment that I worked with him on, the fire in me to be like, I can do this, just any of these guys can do this. And I'm extremely lucky because I have a husband who's incredibly supportive of that mission, which is, one, I'm going to be more transparent. I'm not going to do loans the way they were done. I made that decision after the housing crash of 2008 to 10. And I was like, there's a better way to do this. It's more transparent. I want to be more communicative, and I want to just educate the client. These are their loans. My job is to educate them and making sure that they understand what they're getting into and what their options are so that they can best make a financial choice for themselves.
We've found in this podcast, we've spoken to so many actual experts, all women, who have said in so many male-dominated industries, there just aren't, and your generation are breaking the glass ceilings of role models to aspire to, because it's hard to aspire to something that you can't see or have never seen done or don't understand like the stepping stones to get there. So it's encouraging to hear that there's more and more, but it sounds like it's still a work in progress. Yeah. And it's hard work.
It's absolutely a work in progress. And there's no doubt that there still are a lot of the good old boys clubs within our industries. I think we all feel it, but we're not letting it stop us. So I refuse to use it as an excuse of why I didn't succeed. Do I have to answer twice as many questions for people to believe me? Probably, but I will just keep answering them. Do I have to work twice as hard to gain somebody's trust? A lot of times. I don't love it, but it's part of what it is. And like I said, I still refuse to let that stop me. I have a 20-year-old stepdaughter who was watching me through this whole career, and I knew I had to be a role model for her in what it looked like to come up in an industry. And that was extremely important to myself and my husband, was for her to see that she can be a powerful businesswoman if she wants to be. And she only needs herself to do it. She doesn't need anybody else.
We love it.
I love that. Well, shout out to her and to more role models. Just the visibility aspect, I think, is so important. So, okay, so many avenues we could go down, but you mentioned that your job is to see clients and to assess what type of loans they can get, what's best for them, and how to move forward then in getting a mortgage. So if I were to come to you as a first-time buyer, what would be the first couple questions that you would run through? What are you looking at to assess how much I can afford, what type of loan I can get? It sounds like it's very case by case, but just maybe some of like the general. Are you looking at my credit score? How does it work?
I love this question because the majority of people call and they don't know what to ask. So they're like, what's your interest rate? And that's such an ambiguous question, and I'll explain why, but they don't know how much goes into determining what that rate is. So you're 100% right. Interest rates are very personal. So when I talk to somebody, I like to understand what they're doing. Are we buying a first home? Are we buying a second home? Is the long-term goal to be an investor? We've got a lot of young kids right now that are really interested in house hacking, which means they want to buy now, live in it, rent it out later, and they want to start their rental portfolio that way. There's a lot of conversation we had of what's the goal. So I typically start there. From there, I do ask, without pulling a credit, tell me about your credit. How do you feel about it? Is it good? Do you feel like there's maybe some blemishes? So they're really honest. They go through that with me. So that tells me a little bit of what I need. The other big one is, where do they work and how long have they been in that job? In our industry, we have to assess the risk. What is our risk? And I think sometimes people forget that and they just automatically think all we want is their personal information. And that's really not the case at all. But we need some of that personal information to understand the risk that's going to be involved. And so if you can show good job history, that lowers your risk because we care about getting paid back. We don't want to foreclose on you. We just want you to pay us back. We want to make the money on the interest that we're charging. We want you to live in your house. It's that simple. But we also want to make sure that we're going to get the monthly payment from you. And if you're a job hopper, that shows us that could be unstable as far as income and making sure we get paid. So the job history is a lot bigger than people anticipate sometimes. And then with that, we do eventually pull a credit report. And then that tells us what liabilities you have to the income you have, because we're coming up with a debt to income ratio. And that's where we're determining what does your house payment need to be to stay within that debt to income ratio. The other question that I ask, because some people become so fixated on the interest rate when really the interest rate matters. I don't want to say that it doesn't because you pay interest over time. The average loan is 5 to 7 years. So the interest rate does matter, but it's not as big of a deal as what a lot of people think it is. What matters is the monthly payment you're tied to. Because at the end of the day, we make emotional decisions on what our bills are and what we can afford to do after our bills are paid. And one of the things I try to explain the most, especially to first-time home buyers, is I understand you think that $2,500 a month is okay for you to pay for your monthly payment, but if your debt to income ratio is 45% at that $2,500 a month, that tells me that means you probably can't go out and have fun. You're going to have a hard time going on vacation. And I don't know a whole lot of first-time home buyers that don't still want to live outside of their four walls, because those four walls, meaning your home, close in really fast if you can't have a life outside of it. Whether that's going out for dinner once a week or going on vacation or just hanging with friends, going to have a few drinks, whatever the case may be, you want to be able to live outside of that. And so I really like to focus on what that monthly payment is and where that comfortability is for people, because that's going to determine how they live their life and what style of life they want to have.
Makes total sense. Caitlin brought up the term house poor in the intro. And what a lot of people we know, younger people who have made the decision to buy the house, who have very quickly realized that it can influence every other aspect of your life if you don't have, to your point, the right debt to income ratio when purchasing or when deciding what to purchase.
We should just quickly clarify, what is a debt to income ratio?
Yeah, perfect. Debt to income ratio is if you have, let's say you have $300 a month of debt and you make $1,000 gross income. That's 30% debt to income ratio, right? Is my math right there?
Yep.
So yeah, you have 30% debt to income ratio. So we assess what your debt to income ratio is before you own the home, and then we assess what it is after you own the home. So let's say now we're going to change the numbers a little bit, because obviously it's really hard to find a home with all the payment under $1,000 a month these days. Like, it just is. So we're gonna be realistic, and let's say you have a $500 car payment, and your house payment's going to be $1,500. Okay, that's $2,000. And let's say you gross income $5,000 a month. right? So what you're going to do is you're going to take that $2,000 a month that you would have to pay out in bills, and you're going to divide that by $5,000. It's super easy math that way. And your debt to income ratio is going to be 40%. So that means 40% of your gross income is going out the door to bills you have to pay.
Got it.
The big word in there is gross income. We don't use after tax, we use gross.
I was thinking that.
And so you've got a lot of loan officers out there right now that can go to 49 or 55% debt to income ratio. Now, if I'm taking you to 55% debt to income ratio and you have no other jobs and you have no other way of making any money, you are going to be in a world of hurt because I am not taking into consideration cell phone bills, internet, water bills, your electric bill. I'm not taking any of that in consideration after the fact. I'm only taking in what your hard liabilities are that show up on your credit report.
Right.
So that's why there's a lot of loan officers out there. Oh yeah, you qualify for $500,000, go buy the house. And don't educate the client on this is what your debt to income ratio is going to look like. Do you have another source of income? Now, I don't mind going to a higher debt to income ratio if, for example, we have a young couple and we're only using one of their incomes. We're not using the other income at all.
Sure.
For different reasons. Sometimes they're not married yet and they don't both want to go on until they're married. They just want one or the other to buy it. Sometimes one of them is cash is king and doesn't have any credit. And so it's easier if we just put the house in one person's name because they get a better interest rate with a better credit score, things like that. So there's a lot of reasons why we would go to a higher debt to income ratio. But if I'm working with an individual or a couple and I'm maxing them out on their true household income, that's a hard pass for me. I'm not going to set you up in that because you're going to call me in 2 years and probably, or maybe not call me because you now hate me because I put you into a really bad situation. Right. And that's not being fiscally fair to our consumers. Yeah. And that's why it's so important to educate them.
Is there a specific number you think people should look for when they have this conversation? So you said 49%, 55%. But going into it, I think it's good to know I want my debt to income to be X. So this is how I will be able to say yes or no to this interest rate that's being offered.
Financial management says 38% is a really good debt to income ratio when it comes to all your debt and a house. So that would be your total debt to income ratio. Honestly, there's some factors that go into that because I might tell you have a 45% debt to income ratio, but maybe you've only been on the job for a year and a half. So I'm only using your hourly income, but you have commission and bonus income I'm not using. So there's a lot of income I'm not using there, which tells me your true debt to income ratio is probably in the 30s. Then you're okay. But if you're using all of your income and you want to live a super comfortable life, the key is to stay right around that, maybe 38, maybe you go to 40%, but that's where the sweet spot is to be truly comfortable with all the outside bills we don't take into consideration. Life insurance is another one, or putting into an investment, a 401k, things like that. We don't take that stuff into consideration with your debt to income ratio. We take your homeowner's insurance into account, but we don't take vehicle, health. When you start adding that stuff up, it can be pretty costly per month. So you want to make sure that you are comfortable in your living space.
So you should effectively do your own exercise because you could come to a loan officer and they could give you one debt to income ratio that doesn't take into account so much more of your lifestyle. And so that you should really do it independently of a loan officer who, unlike you, our actual expert, may not have your best interest in heart in terms of lifestyle and like longevity of the loan. Okay.
Most people that I sit down with, I'm like, okay, when we do the pre-approval, I'm like, I want you to go home and I want you to list out all of your debts, all of your bills, not necessarily debts, but bills. I want you to look at the end of the day, how much money you have left over and tell me what a comfortable house payment is for you, because that's where we're going to pre-approve you. Because that's where it's going to be comfortable for you. You might think $2,500 a month is comfortable when really it's $1,800.
Yeah, and that's a big jump.
That's a big difference in what kind of house you're going to go buy. So I always, some people come to me and they've got it all on a spreadsheet and they're really good at that. But there's also some people that come to me that are completely blind. They're learning. They don't know. They've never been taught. They don't teach this stuff in school. And so when they are that green, I really like to do those exercises with them because I want to set them up for financial success and home future, because the last thing I should be doing as a mortgage advisor, if you will, is setting you up to be house poor, because that's not helping your financial future at all. It's setting you up to fail later on. And I couldn't sleep at night if I knew that's what I was doing just so I could make my job easier. Like, I'll go those extra steps. It's not always easy, but it's worth it.
Totally. Okay, this is really helpful. And I think this brings up one of the biggest conversation topics of people our age, which is, should I be buying or renting? We have this idea that everyone wants to buy. We were talking about the American dream earlier. You know, what our parents bought when they were our age. And so everyone, not everyone, but a lot of people aspire to that. It's expensive to do these days. And I think it's unrealistic for a lot of people. So is there the same type of calculation that you could do where saying my rent would cost this? I don't have all these extra payments that come with buying a house, which isn't just the sticker price, to your point. It's like all the insurances and the, everything else that comes with that.
Yep.
And basically compare the two, your debt to income ratio of renting versus buying. That doesn't take into account, though, what you just mentioned, which is long-term wealth accumulation through home ownership. So can you speak to, if I was a client coming in to be like, I don't know if I should be buying or renting, I think I want to buy for the long term, what would you be considering in that?
I love the question. And to kind of go back, a loan officer only makes money if they close a loan, right? So most of them are going to tell you, buying is obviously the better route, right? I'm that random person that's going to tell you it's not right for everybody to buy because they have different things. It's just not their time. I'll use my daughter for an example. Yes, would I love for her to own a home? She's 20 years old. I'd love her to. Right now, it's not her time. She's still building her career. And yes, could my husband and I have helped her buy a house? 100%. But at the end of the day, we, again, want her to be independent in that. And she has to learn how to start paying bills first. So start with renting, where utilities are included in your rent, because you just have to learn how to make that payment every month. And then you can decipher how much you have left over. So that's one.
Sure.
Two, we do have calculators, Lindy, actually. And if you want, I can send you a link for them for the podcast where people can go in and they can play with that. What's the cost to rent versus own? And in 5 years, what am I going to be, if you will, upside down in renting versus what it could be to buy? And for some people, they might decide, oh my gosh, it's absolutely worth it to buy right now. I'm ready to do this. And for other people, maybe they have debts to pay off. Maybe they have, like, I always say bad things happen to good people. Medical things happen to good people that put them into some medical debt that they have to get out of first. And rather than keep loading that on top of it, let's take that into consideration and maybe put you on a plan. I always say there's never a credit score we won't look at, because even if it's not a qualifying score to get a mortgage right now, we can at least still help you prepare to what you need to do to fix that credit so that you can be a homeowner. And sometimes it is saying to people, I think it's smarter for you to just rent for another year yet, and then let's revisit this and just stay in constant communication with them. And two, you will weed out the people that truly want to be homeowners, because they'll stay in contact with you and they'll be like, Kristin, I just paid this off. They're excited. They're proud of themselves. And so they'll, Kristin, we just did this. And then I'm like, okay, we're on the path. We're going to get there, and they're going to be buying in a year. And I call that, it's serious, but funny, that's job security for me. You know what I'm saying? That's job security. And that means putting somebody who's right time in a home, even if it's next year, because then they're going to be proud. And then in 3 years, they're going to want to upgrade, most likely. And then in 3 years or 5 or 6 years after that, their family's growing and maybe now they want a second home. That's where it's job security, because now I've earned their respect and we've done right by them to continue that relationship and continuing to get their business later on. Instead 100%. Of just throwing them into a loan right now that they don't understand and leaving them hanging.
Well, everyone would be so lucky to work with then a loan officer like yourself who has that ethos. And so the education around what you as a buyer should be looking for and shopping around for a loan officer who has your best interest in heart. You wouldn't know otherwise what to look for. And I think as you go to ask for a loan, you think that you're in the position as the recipient, and you're kind of like, whatever you say is what I have to do to get there. So I think, these are just amazing takeaways in terms of like what people should be looking for, just even in the officer, let alone like taking the process forward. So massively helpful. Caitlin, any questions to do with this before I want to talk about home markets, but go.
I feel like it's just a yes or no question on this, but it sounds like you can have these conversations with a loan officer before you even start looking for a house. And that might actually be a good idea, because then you don't fall in love with a house you can't afford. Is that possible, that before you even have your eye set on a house, you go to your loan officer to understand what amount you can actually borrow and afford?
Yeah, I love you for saying that. And I wish more people started that way, because that is actually the right way to start.
Okay, that's good to know.
Because of that factor. So there's a couple of key factors on that, Caitlin. One, sellers don't want to they don't want to clean their house and leave their house for you to come in and look around if you're not pre-approved to buy it. They want serious buyers. So that's first and foremost. Two, a real estate agent, yes, their job is to show you houses, but at the end of the day, they're leaving their families behind to show you houses, typically nights and weekends. They don't want to do that and show houses to people that can't afford to buy that home. They want to make sure that they're working with somebody that can actually get into the house and can actually afford to buy it. So when you're pre-approved up front, it's going to be stronger for you. You're going to have a better experience in buying. What typically happens, and I wish I could change it, we've been trying, and real estate agents alike too have been trying to change it for years, where you start with the pre-approval, then you go to a real estate agent, tell them the type of house you want, and then you go out shopping for the house. What typically still happens is the person finds the house on Zillow, then calls the real estate agent to see it. The real estate agent says, "Are you pre-approved?" They say no. Then it's a mad scramble, because the house is going to sell in 2 to 3 days. And now we're throwing caution to the wind, and documents are flying and people are rushing, and then they're missing stuff. And then it's an anxiety-driven situation that starts off without the best foot forward. If I could have every person start out with a pre-approval and then work with their real estate agent, that would be like heaven.
Okay, that's good to know. Set yourself up also for emotional success, because I think there's a lot of emotions on the line there. Cost and energy.
It is. And one of the things people do, to your point, is they look online and then they're like, "Oh, I can totally afford that house. It says that house is $1,500 in the mortgage calculator." But what they're forgetting is they didn't add in taxes. They didn't add in private mortgage insurance. So now that principal and interest is $1,500, but the total payment is maybe $21,000. And then all of a sudden they're like, "Oh, I can't buy a house in that price point." And so it does become emotional. And then they feel defeated before they even started. And that's the last place you want somebody to be. You want them to feel empowered, and you want them to feel energetic. It's a big deal. It's a really exciting time, and you want to enjoy every part of it.
So you mentioned that 2 to 3 days, for example, if someone comes to you and is like, "I'm desperate for this house, how quickly can we do this?" is way too fast a time frame. How long would you recommend someone give themselves at minimum to have a responsible and relaxed experience in getting a mortgage start to finish?
Yeah. So for the pre-approval time, amazingly enough, we typically can get them done within 24 hours. Sometimes 48. It just depends on how long does it take us to get your documentation. Is it 6 o'clock at night? Then it might be tomorrow. Is it the weekend? Is your credit frozen? Can you even call to get it unfrozen? There's a lot of aspects that go into that. But typically it really only takes 24 to 48 hours and to be comfortable doing it. So it doesn't take a long time at all. But then from the accepted offer to closing, I would say right now we're working within 21 to 30 days on average. Our average turn times for our company is about 22 days. So from start to finish, that's appraisal, that's title, that's getting all the documents, underwriting, everything done. So it goes fast enough as it is. It really does.
It's so interesting because we did a episode on what the fuck is a prenup with a marital law lawyer, and she said that the process of getting a prenup sometimes takes 6 months or longer for them to really draft out the contract and everything properly, which was a lot longer than we had anticipated. So I thought this would be a months long process. So that's a lot faster than I expected. Who knew?
And
Good to
I
know.
think people have the misconception that it is, and I understand why. But then when they hear it goes that fast, the problem is then they go, oh, I'll just do it then when I find the house. And then the house shows up at the last minute on a Friday afternoon, and then they can't get a hold of anybody. Where if they would just do it, it's good for 4 months. Pre-approvals are good for, yeah, they're good for 4 months. So if you're even thinking about buying in the next quarter, you're covered. You're good. Start your pre-approval, get it done. So it's just one thing checked off the box. And if you don't buy a house, it's okay. There's not any big bills that come with it. We don't have any big charges or anything like that comes with it. Of course, we'd love to see you buy a house, but if you don't, that's okay.
Okay, that's great to know. Good for 4 months, not a massive undertaking. You can repeat it every quarter until you find the dream home.
Yep,
Great to know.
absolutely.
Amazing. Okay, now I want to kind of understand, you mentioned earlier on in the conversation a good housing market versus a bad housing market. What does that mean exactly in terms of buying and selling, and what should, as a buyer, what should you be looking for?
Yeah, so it's a tough question because any loan officer you're going to talk to is going to tell you that now's the time to get in the market, right? It's one of those easy cheeseball sales line. Now is the best time to get in the market. The reality is that you should never try to play the market because the market's going to do what the market's going to do, whether that's up, down. What a lot of people don't realize is that when they buy, if rates come down, they can refinance to a lower interest rate as long as they qualify again. So that's the key point. They have to requalify. So if they have a bunch of missed house payments and things, they might not be able to. But if they stay true to their house payment, they keep their credit up, their jobs are good, they should be able to requalify to refinance and then save that money.
Okay.
So that is possible. So timing the market, you're never going to hear me say time the market because I've even in the business, people are like, what's a normal market? And my answer is always, I don't know. I've been doing this almost 24 years and every year it's a different market. And every year it is. When it's a buyer's market, it's good for a buyer. When it's a seller's market, it's good for a seller. We're just coming out of a seller's market nationally, where the seller could pretty much say, this is what I want for my house. You're going to pay me. No, I'm not going to accept your appraisal contingency. I'm not going to accept your inspection contingency. Those kind of things were great for a seller. But on the buyer side, we're not great for a buyer. And some of what we're feeling right now are sellers that sold because they could, and they left their issues with a buyer right now who is struggling because now all of a sudden the furnace went out and the water heater went out, and then all of a sudden there's a leak in the roof that they said the roof was brand new 2 years ago, but it wasn't put on by somebody licensed. Like, those are real things that I'm talking to clients about right now. And it was unfortunate, but the double-edged sword was, if you didn't buy in that time, under those circumstances, you weren't buying.
Right.
And so if you wanted to buy a home, that was what you were going to do. And so, there is give and take. Why I love the market we're in right now is because buyers actually have some breathing room to look at a house, maybe more than 10 minutes. Like, maybe they get a second or third showing. They can actually do a little bit of negotiating, and they can ask for that inspection to protect themselves, which lending doesn't require a home inspection. But it's my belief that every buyer should be entitled to a home inspection if they want one, because they're buying it and they should know what they're taking on. They should know. And sometimes the sellers don't know that there's something going on, but sometimes they do, and they choose not to disclose it and then leave it to the buyer. So I always feel like if a buyer wants an inspection to protect themselves, they should be able to have one.
Yeah.
And so now they're able to negotiate a little bit more into that. And now the market is really timed for both buyers and sellers. But then you bring in rates are a little bit higher. But then you can refinance them down. So that's where it's like, I don't know that there's ever a perfect time to buy or not buy. It's when you're ready is more when you feel fiscally and emotionally ready to take on home ownership. That's when it's the right time.
That's great. That's great to know. I did want to touch on, you mentioned refinancing, and this was one of the definitions that I wanted to understand. Is refinancing the same as remortgaging? You hear that in movies, or you hear like, my dad lost his job, so we remortgaged the house. In my mind, that's always there was always maybe a negative connotation. It meant that maybe things weren't going as well. But it seems like there's maybe a positive angle to it if actually it means that you'll get a lower interest rate in a good way. So can you explain what does that mean exactly?
Yeah, so a refinance, it's a great question. A refinance is a positive, typically a positive thing. It means that you're refinancing to what most would say is a lower interest rate. Now, there's other reasons for refinancing that aren't so positive, which, like, if you get divorced and you have to remove a spouse from the mortgage, then you might have to refinance to take part of the equity out and pay your spouse off. It's not always glamorous. There are some of those times, but the majority of the time it is to refinance to a lower interest rate. You do have to requalify, which a lot of people don't realize, but you do have to requalify. You have to go through underwriting. Sometimes you need an appraisal. You have to do those things. We still have to do title work to make sure that you haven't left anything unpaid where a judgment might come in behind us, like we talked about earlier with the liens. I think what you mean by remortgage, at least what I've heard in the example you gave, is more of a loan modification where if somebody loses their job, they can call their current loan servicer and work out with them, maybe missing a couple payments, putting their mortgage on pause till they get a job. Or sometimes what they'll do is they'll modify the mortgage, which can take the term out a little longer to break the payments, to give the payments a little less, to make them more affordable during that time. For example, when COVID was going on, they put a moratorium in where if you lost your job or you couldn't work because of COVID, that then they put your mortgage on pause for X amount of months. The interest was still accruing, but they'd add it to the payoff instead of adding it to your monthly mortgage. So there are things like that can be done for different circumstances.
Maybe what I'm thinking as you were explaining that, maybe I was wrong in that the term that you hear in movies, for example, is I took out a second mortgage on my house because things weren't going well.
The second mortgage would, a second mortgage is where you take a loan out on the equity. So let's just go back to the prior example of the $300,000 value of the house, but I only owe $150,000 on it. So of that, you can typically borrow up to 90% loan to value. So if I'm doing a $200,000 loan and I go to 90% loan to value, that means I can borrow up to $180,000. Well, if I owe $150,000, that means there's $30,000 of equity that I could technically tap into. And maybe I take that loan as a second mortgage and then I get the cash and now I can put a new roof on. I can afford to pay for windows. And you're leveraging that, going back to that leverage word, you're leveraging your equity in order to pay for something now. And then you make monthly installment payments on that equity loan, just like you would your first mortgage.
Okay, so that's, I think, more so what I was thinking.
Not a negative thing. For instance, I'm pretty open about, not details, but with my own circumstances. And we took out a second mortgage on our home to buy another property because we had equity in our house so that we could buy another property that's now making money for us. So there's also really good ways where you could utilize that. Some people do it they get themselves into some debt and they use that to pay it off. And they have a lower interest rate than a credit card. So it's a little bit more responsible to do it that way. There's a lot of different reasons. I think it's a great question. I think it's just a good recap of it.
Thank you. I have a quick question because you mentioned the word payoff. And then earlier you said a 5 to 7 year loan. So I'm just trying to understand the life of a mortgage because you hear I have a 30-year mortgage. So what is a 5 to 7 year loan versus this 30-year mortgage and then this word payoff?
So great. Some banks do, and there are servicers that do lend for the full 30 years. The majority of loans pay off in 5 to 7 years because people either sell the house or they refinance. So the likelihood of somebody being in the same mortgage for 30 years is pretty slim to none. Where you're going back is when, like, our local banks will do what we call adjustable rate mortgages. And why people tend to gravitate towards them is because they tend to have a slightly lower interest rate than a 30-year fixed. And that's because the bank is willing to give them an incentive to a lower interest rate because they're going to be paid off in less time. So they're not taking on a large risk. They're taking on a 60-month risk or a 72-month risk versus a 360-month risk on a 30-year loan. So they'll give you a little bit of a lower interest rate, because their risk is then a lot shortened because you're guaranteeing them you're going to pay them off in a shorter amount of time. So that's typically why people will go towards an adjustable rate mortgage.
And so in that period of time, are you legitimately paying everything off and then you borrow again and you're readjusting? Is that how it works?
Yeah, so there's a couple different ways. It's considered an adjustable rate mortgage because, and I'll break it down. Let's say we're doing a 5-year ARM. That loan is locked in for that 5 years at the same interest rate. Now, at year 5, you can either refinance to another mortgage, you could sell the house, you could pay it off in full, or you can refinance, which is what most people do, is then they refinance to another either adjustable rate mortgage, depending on where rates are at, or to a fixed rate term then. You had a lot of people doing adjustable rate mortgages in the last 5 years because we came off of really low interest rates, right? So we came off of 2, 3, 4% interest rates. And then your fixed interest rates went up to between 7 and 8% in most cases. So what people were doing where they were like, I'm going to take an adjustable rate with my local credit union because I believe in the next 5 years rates are going to come down. And then I'll take a long-term loan at that time.
Okay.
Which is great in theory and will work for some people. The part of it that I have found, and I'll just speak on my behalf because I hate saying always or never because it's always that little bit of a difference, right?
Right.
But I have unfortunately talked to a lot of people that when banks put them in those adjustable rate mortgages, didn't explain to them that they had to requalify to refinance. Perfect example. I had a gentleman call me who bought his home and he bought it on an adjustable rate and he was working at the time. And then in the middle of that adjustable rate decided to retire. And now he's on a fixed income. His fixed income is perfectly fine to pay his bills, but then his debt to income ratio is like 80%. He does no longer qualify to refinance. So if he stays in that house, that adjustable rate mortgage then does exactly what it says, is it adjusts. And some of those rates can adjust anywhere from 2 to 5% in the first year. So now let's say your adjustable rate mortgage was 5%. And in that first year, it adjusts 2%. Now all of a sudden you're paying at a 7% interest rate. And then every year thereafter, it can continue to adjust higher if the market's higher. And that poor guy now is stuck because he's on a fixed income, he doesn't qualify. So the option is either to sell the house or continue to pay a higher interest rate. And unfortunately, he's a prime example of a loan officer who didn't explain to him what happens at year 5. They just said, oh yeah, don't worry about it. Rates are definitely going down. They didn't. They didn't go down. They went up. And so that's some of what we're seeing right now with people in adjustable rate mortgages. So the reality is people need to understand that they are a risky loan. They are. Yeah. If you know for a fact that you're going to be paying that off in 5 years, whether you pay it off with your own liquid money or you're going to sell, they're great. They're absolutely great. But if you're staying in this house long term, they're extremely risky.
See, this answers my question, Caitlin, I think from the intro, where my grand question about mortgages forever was like, how do you buy a house with a 30-year mortgage? Because I feel like that's always the number that we hear.
It is.
And then if something happens to you financially and you can no longer afford the house, you sell it, but for less, and you buy a cheaper house. I'm like, what happens to the 25 years left on the mortgage? Like, do you have to continue paying that? Does it just disappear? But it sounds like more mortgages are shorter term. And so every 5 to 7 years, you're either getting a new one, refinancing, or selling the house potentially. And that, so it's a shorter time frame than this 30 years that you hear, unless you think you're going to stay in the house and your finances are going to be the same forever or better. But like life happens. So things happen all the time.
Life absolutely happens. Another example of the one I just gave you is the couple that bought their first home and qualified for their mortgage. And then maybe he or she stayed home to take care of the baby that they just had. And now they're on one income and they don't qualify. So their life changed. So life changes all the time for people. And so that's why it's different. Yeah, the average lifespan of a mortgage is typically 5 to 7 years. But even if they take a 30-year fixed out, they can stay in it. And that payment will stay the same for 30 full years if they want it to. They can typically always prepay If you're buying a house and you're doing a 30-year fix with Fannie Mae or Freddie Mac, there's no prepayment penalties on those. So you can always pay it off as soon as you want to. I'm a firm believer of at least making one extra payment per year. It typically saves a client. It just depends on the loan amount, but let's go back to a $300,000, $400,000 house. If you pay one extra payment per year, you pay that house up in most cases in about 24 and a half to 25 years, saving 5 years of interest, which can be somewhere between $30,000 and $50,000 in that 300 to 400 span. So you can save a ton of money by doing it that way. Some people do stay in the house for a full 30 years. Typically, though, people either move up, move down, buy a bigger house, buy a smaller house, just depends on their age and things to that nature. But the 30-year fixed rate is so popular because it does keep the payment down. They can prepay it if they want to, so they can overpay at any time. So it gives the consumer more flexibility in their own payment, how they want to pay it. And two, it's got zero risk. So it's the same, you know exactly what it is until you pay it off.
I do have one clarification question before I want to get into some like rapid fire myths, but you said a prepayment penalty. Does that mean that you could get penalized for paying off your mortgage earlier than agreed?
Yes.
Why would that ever be the case?
Yes. So a perfect example of that, that's typically what we would consider your outside investors. So they'll put on a prepayment penalty. The reason why they do that is because investors only make money on the interest. So if you pay them off right away, they've made no money. So they've invested in you and made no money. So they at least want a return on their investment. But what they'll say is, I'll give you a slightly better interest rate if you'll take a 5-year prepayment penalty, because then I'm guaranteed X amount of interest in 5 years. And I'll incentivize you and give you a little bit of a lower interest rate in order to take that penalty.
I see.
Yeah, they're not super prevalent, but they do exist in some cases.
Okay, that's so helpful. Thank you.
Yeah.
Okay, amazing. I want to run through a couple myths or misconceptions. I'm going to say something, you can say true or false and kind of explain.
Okay.
So the first you kind of have already answered for us, but you need to be debt-free before you can buy a home.
False.
True or false? False.
False.
Taken into account, it sounds like, for the interest rate that you get, but you do not have to be debt-free before you buy a house.
Right.
Thank you.
Yes.
Number 2 is buying is always better than renting for building long-term wealth.
True for long-term wealth, but there's going to be that person that's going to make a comment that says, no, because I've invested in my investment account and it's making money on money. So there's always going to be that one-off. But speaking for the majority of people, yes, I do agree that home ownership is one of the tools for long-term wealth.
Next is over the life of a 30-year loan, so what we were just speaking about, you can pay 2 to 3 times the original home price in interest if you don't refinance or pay early.
Yes, false or true. Yes, false, true. No, it is true. Yeah, it is true. You will pay typically about double. You know, the higher the interest rate. Yeah, the higher the interest rate, the more you'll pay. So yes.
Wow. Over the life of a 30-year loan, you can pay 2 to 3 times the original home price in interest if you don't refinance or pay early. That is crazy to think about, but good to know that refinancing is an option and a good one. Didn't know that before, so thank you. Okay, here's another one. You need 20% of the total home cost upfront to purchase it.
I do a lot of loans with no money down.
Interesting. Okay.
Yep.
So it's case by case, depending on that person.
Yeah. So it's very dependent on your credit. And a lot of those programs are income driven. So they're driven for workforce. So they're trying to make sure that our workforce has the ability to get into a home where they can absolutely afford the home on a monthly basis, but maybe they don't have a huge savings for a down payment. So it's still better than renting for them. So 0 to 3% down is a big one for first-time home buyers. I would say the average down payment for most people is on average 10%. So you're taking your 0% or you're taking your 20% down, but there's a lot of people that'll choose to do 5 to 10% down because they're making more money in their investments right now. And so their CPAs and financial planners will say, no, put down whatever you need to qualify, whether that's 5 or 10% to get to the payment you want. And then we're going to leave the rest of it here because you're now paying 6% interest rate, let's say, and your investments are making 8%. So you're making more money on your money over here. So we've got a lot of people right now that rates are down who are choosing to go that route.
And you see that, you see like in the news, it's like Adele, I remember reading like Adele bought this $25 million house with a mortgage. Like, is she having financial troubles? And everyone's like, she can pay cash for that, but it's a better financial decision to leave the cash in the markets because she's making more money there and can pay the mortgage. Which so I never understood what that meant.
It's good debt versus bad debt.
It's exactly correct. And that's so true. For example, VA. If you're a veteran, you can do no money down. And my husband's a veteran, so our loan was VA. And we chose to put no money down. It did not mean we weren't financially solvent to put that money down. We took all the money that we made on the home that we owned prior and put it into investments because he was afforded the ability to put no money down. It was much smarter for us to invest our money. And at that time, our interest rate is 2.25%. So it made zero sense for us to put that money down when we were making, I don't know at the time, it was 5 or 6 years ago, but 7 or 8% in our investments when we were paying 2. That's a 5% change on a lot of money. So it's a misconception that you can't. And that's why I'm always so open about our situation because we're real life people. And my mortgage is going to be the last thing I pay off because there's no reason not to. I prepay it. Like I said to you guys, I do what I preach. I prepay one payment a year to pay it off early, to pay as little interest as I can to get ahead of it. But at the same time, it's going to be the last thing I pay off.
So helpful. So much more makes sense honestly, these things that we've been hearing for so much more makes sense, truly. I have one more question before our final question is, how do you suggest someone finds the right loan officer, be it at a bank or a private like mortgage loaning institution like your own? How can someone find someone as great as you to help them through this process, at least in the US, maybe?
Yeah, thank you. I appreciate your kind words. First and foremost, read reviews. And if there are no reviews, that's a red flag. And then I would always say too, word of mouth. So go to somebody you know and trust and get that word of mouth. It's far too often and easy for people to just say, oh, I just went online and got this approval. And one of the things that isn't talked about a lot, I wish we had 5 more hours I could go on and on, but there's a lot of loan officers, unfortunately, that don't understand guidelines. And so they just spit out whatever they want to. I'm cleaning up a loan right now that the loan officer had no business writing this loan for this client. And they are in a world of hurt where document after document, they're frustrated. And I hate that this is the way they're going into it. And it's just the lack of knowledge. Of course, every loan officer is going to tell you that they're the expert in every single field because what did we say earlier? If they don't close loans, they don't make money. And so their word of mouth, referral base, and reviews, especially now that reviews are so easily accessible. Google is great. If you hear the same thing over and over again, great communication, competitive interest rate, those types of things, that's what you want to see. Communication and competitive. If they're those things, then that's what's going to help. Obviously, if it says that we closed on time, it really helps as well. But communication is the key word if you hear it over and over again, because that's somebody who's not going to run and hide from you.
Yeah. Okay. Those are so helpful. And it sounds like there's a bit of a vibe check. Have a meeting with someone and see how you guys literally vibe, as we say. But just,
absolutely. I tell people to shop all the time because I think that they should talk to the people, get the vibe, because you're going to understand. Anyone can pick up the phone and say, yeah, my interest rate's 5%. What are the fees that come with that? If they don't explain anything, and if you're just not feeling it or they're not answering your questions clearly and concisely so you can understand, huge red flag, run.
Thank you. So helpful. Okay, we like to end every episode by asking our actual expert, what is one thing that you wish all women knew about the topic? So what is one thing that you wish all women knew about mortgages?
That they are way ahead of men when it comes to buying, whether they're single or married. We mortgage more women than we do men. And that number climbs every year. And I just love to see it. So many times women think that they can't do it on their own, and they absolutely can. Absolutely, without a doubt, they can. I don't love it sometimes when I love to help a woman, but there are times where they're getting divorced and they don't have a clue where to start because their soon to be or ex-husband never let them be a part of finances or understand. And so I don't love it for them, but I love it because I get the opportunity to help empower and educate them so they feel like they can do it because they can and they should in a lot of cases. But it's one of those where they are absolutely dominating in the housing industry in purchasing.
I love that. What a positive note to end on. And truly, we would all be so lucky to work with a loan officer like you. You're exactly
Thank you.
who I will be looking for wherever I end up one day, I'm sure, hopefully.
If you come back to the United States, I'm licensed all over the place, so let me know.
That was actually going to be a question was, is it state by state or is it national or state by state?
You have to be licensed state by state. So there's different, I'm licensed in a lot of states. Some of us are, some of us are not. My company lends in 32 different states right now, and I myself am licensed in 10. If I have a client that needs me in that state, I'm happy to get licensed to help them or refer somebody that I know will take care of you if I can't do it.
Amazing. Oh, amazing. Kristen, honestly, I can't tell you how much I've learned, how much we've learned. I'm so excited to get this one out here. This has been one of the highest requested episodes. We will make sure that we put your information in the description. I would love to get that calculator from you, the one that kind of shows you a little like buying versus renting.
I'm going to make a note right now so I send it to you.
Perfect. Yeah, I'll follow up with you. But truly, this has been amazing.
Welcome to the Debrief, where we discuss things we needed a little more clarity on.
I was thinking also, I don't know if we want to do in this episode, but I was looking at Catherine Hicks's story, and it's just so crazy that we know so many girls that have started businesses.
I know.
And so many of our friends.
I know.
It's so cool.
I love it. I know. We should put Hannah Daffern on.
I know.
We should really do that. Yeah, like maybe like a female founder series.
Yes, that's a good idea.
But we are here to talk about mortgages.
I know.
This was, I think, tied probably with blockchain.
Yes.
I learned by far the most.
Totally. So also like actionable things. Like I'm like, okay, now I know here are the next things that I need to do. Because Stephen and I have spoken about, do we want to buy a house in the next few years, like, or even in the next year? And so this was so helpful. I literally went straight because he was locked in the bedroom while we were recording and wasn't allowed to come out. And I went straight in and I was like, oh my God, I learned so much. And then I was like, blah, 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 blah. And he was like, yes, okay.
I know, but practical things, and she managed to answer quite literally all of my questions, including the omnipresent question of what happens to your 30-year long mortgage when you sell your house or you don't have the money to pay it off. And the answer is they're not all 30 years. So there you go. Who knew?
And you can pay it off early. Sometimes there's a mini penalty, but you can do it, which was one of my questions. Can you pay it off early? Should I go rapid fire through my takeaways?
Yeah, please.
Okay, so first one is before you go to your loan officer, you need to understand your entire finances, what you pay every single month to really understand what you can afford, because that will affect your debt to income ratio. And not all loan officers will help you understand that your debt to income is pre-tax, not after tax, and also pre all of your other expenses. So I was like, whoa, that was a huge thing for me. Know what you can afford.
Know what you can afford and know how greatly buying a house can impact every other aspect of your life. You know?
Totally.
Like, totally. And it seems obvious. It's like, okay, you have this, you're basically undertaking a huge loan. Okay, got it. But like, I think you don't realize that actually you could be taking a hit to like every other aspect of your lifestyle.
Totally.
That'd be worth it.
I agree. And there's such emotional sides to it. Then you just want to nest and you want to have a place to call your own, but maybe one bedroom less than you expected.
Right. Exactly. And that's the thing. It's not you can't. It just might be like adjust your expectations of what you can, or maybe rent a few more years to build that to get where you want to be. You know. Yeah.
Exactly. My next one was going in and discussing with the loan officer before you get your heart set on a house and do it early to really understand what you can actually afford. And then you're going into the market with an educated approach.
Yes.
And you know not to break your heart when the house is like 300K more than you thought you could afford it, and you actually can't because you can't afford the mortgage.
You can't afford the mortgage. And I thought it was interesting that little mortgage calculator at the bottom of the real estate page is like not a realistic representation of actually how much you would owe. And so don't trust that. Use the calculator that we're going to put in our description to better understand. And also to that point, that when you do get pre-approved, learned what that means when you're pre-approved for a mortgage, that it's valid for 4 months. And then that it's relatively easy and not expensive to continue rolling that over. So if you think that you're even like going to consider buying something in the next 6 months, 8 months to a year, it's worth actually starting the process, and then you can kind of roll it over.
Understand what you're looking for. Though you do have to qualify again, she said.
You have to qualify again. So as long as like your circumstances don't change a ton.
Have not changed.
Yeah.
Which was one thing for me too when she spoke about the shorter term mortgages, that if you do want to requalify after that 5 to 7 year period, but your circumstances have changed, like one person has taken care of the kids, or this is a big one we didn't touch on, is entrepreneurship. I know a lot of people who found their own businesses that have a really hard time getting mortgages because they don't have the steady income every single month. So something to really consider about the length of your mortgage. And
the length of your mortgage, and like potentially understanding that it might be wise to set yourself, obviously everyone's lives and employment look different at various points, but like if you know that maybe in 6 months or a year or in 2 years, you'll both be employed or you'll have a steadier job because you're working towards that, know that that will make your life a little bit easier, but also maybe potentially your mortgage rate will be less. So it's like knowing that could line up, it might determine when you go for it, you know?
Yes, exactly. And that you can also renegotiate. That was a big one to take away. Like go back in a few years' time, even on the 30-year mortgages, you can go back and say like, can I renegotiate for the 25 years left or whatever?
Yeah.
Yeah. Refinance it. Yes, sorry. Refinance.
Yeah.
And my last one was this whole 0% down or less percent down, like 5% down. It makes total sense to me. And this part comes with, if you're on top of your finances, you understand if you've been investing, you know, okay, I'm making 7% annually. My mortgage is 3%, which is an insane mortgage. But if that's the case, there's a spread. It makes more sense for me to take out a bigger mortgage because I'm going to make more money on my money in the bank or in the investment. So just like understanding that and also figuring out like how you can play your money, I guess is a good way to do it. Like best manage your investments.
And I always thought, I don't know why I always heard 20% down. So in my mind, I've always been like, if I wanted to buy a house for $1 million, I will need $200,000 in cash ready to go to put down. And I thought that was just standard, but that's incorrect. So
yes, I guess the offset of that is if you are going to put less down on your house, it means you do have to borrow more money and you have to be willing to pay the percentage on that amount that you're borrowing. So you might need to get a smaller house if you're going to keep money in the market because you're borrowing and larger, and 7% on $1 million is very different than 7% on 500,000.
Yeah. Right. Yeah, that's true. I know. But like honestly, if you explain this to me last night at dinner, I'd be like, I don't understand what you're talking about.
Literally, Caitlin, shut the fuck up.
Yeah, I'd be like, what the fuck is a mortgage? But Kristin just explained it in such, like, I really get it. And I feel like I could explain this to another friend over dinner. And that is the point. And Kristin, I love her entire approach. And I love that she's all about like doing the right thing by people, because so many people who are responsible for other people's money and like livelihoods are not. And I think everyone should go watch The Big Short, because now you're going to understand it.
100%. I agree.
I've watched it a few times, and even
me too.
Margot Robbie, I'm always kind of like,
I don't get it.
And now we're going to get it. So we're going to get it. Kristin, this was a great one. We'll see you next week.
Knowledge is power. Yeah, let's fucking go. Next week is one of our most important episodes to date. We're going to be speaking with 2 forensic nurses, a legal advocate, and an evidence handler on what happens when you go to the hospital after you've been sexually assaulted. We learn about who will meet you and take care of you when you get there, what the process looks like, including your legal rights and protections. Being open and honest, this is a really hard episode, but it's an important one. We're going to learn what we need to know to protect ourselves and our loved ones. Join us next week where we'll be asking what the fuck happens when you go to the hospital after being sexually assaulted.